Good afternoon, all, and welcome to HUD and Terner Lab's third series on housing technology. This symposium will focus on the use of technology and equity in home ownership. My name is Diane Shelley, and I'm the Regional Administrator for the Great Lakes region of HUD. Many of you may already know that HUD is divided into 10 regions. The Great Lakes region includes the states of Illinois, Indiana, Minnesota, Ohio, Wisconsin, and of course, the great state of Michigan. The details of the Great Lakes housing needs may vary somewhat from other regions, but the basic need to increase and preserve affordable housing is consistent throughout the nation. Appointee of the Biden-Harris administration, I'm so proud to kick off this session on the role of technology in home ownership and its effects on equity in the housing market. You see, President Biden and his administration is focused on this issue, which was illustrated in his recent State of the Union address, where he emphasized the importance and urgency of affordability and equity in the housing market. What a complex issue. The nation is so fortunate to have you engaged in this discussion. Now, this administration is working hard. The Biden-Harris administration instituted the Biden Housing Supply Action Plan that was announced last year. It was the first of its kind program. It addressed land use, zoning barriers, it deployed new financing mechanics, and expanded and improved existing forms of financing. FHA has cut costs for homeowners and increased first-time homeowners to the highest rate it has been in decades. Ginnie Mae supported a record $2.5 trillion in government lending. But HUD does not have blinders on. We know that the challenge is to make these funding opportunities reach those at the bottom, those that have been historically and systematically excluded. That is why HUD has implemented an equity action plan with racial, gender, ethnic, income disparity, age, justice focusing activities. We're looking at procurement, fair housing, home ownership, and yes, we can't forget homelessness. But government cannot do it alone. Partners like you are needed. You are the experts, policymakers, scholars, and investors. Together, we can move the needle. Thank you, Terner Labs, for facilitating this gathering. There are several HUD leaders that will address you today, and I am so proud to be in their presence. But I do want to acknowledge our field office director right here in the state of Michigan, Mr. Michael Posanelli, which a lot of you have worked with. The HUD team wants to collaborate and work arm in arm with you as we move forward towards a future of safe, affordable, sanitary, decent, sustainable, client-sufficient housing for all. Now, I would like to turn to Marcia L, the Chief Strategy Officer for Terner Lab, who leads its strategic planning and new program development. She is a leader and an innovator, a rising star in this discussion. Marcia L.
Good afternoon, and good morning to those of you on the live stream from the West. I'm Michelle Boyd, and I help lead Terner Labs. We are the nonprofit partner of the Terner Center for Housing Innovation. The Terner Center is a research and policy center at UC Berkeley, which covers the full spectrum of housing issues, from affordable housing to market rate housing, homeownership to homelessness, and issues of land use and construction innovation, all incorporating an intersectional perspective on reducing climate change and increasing equity. At Terner Labs, we get to put these ideas into practice, supporting innovators through our programs and directly building technology that we think can make housing more affordable, sustainable, and fair. Our focus areas are guided by the Terner Center, and in turn, our work informs the research and policy ideas that they publish. One of our core programs at Terner Labs is the Housing Venture Lab. This is an accelerator that supports early stage innovators and is now in its 5th year. We supported 22 ventures that have gone on to raise over nearly $500 million to expand access to housing and wealth for hundreds and thousands of people. Our innovators explore issues across homeownership and new construction, real estate development, and community building. We're thrilled to be partnering with HUD on this housing technology series and are really grateful for the Howard and Irene Levine Foundation for their support that enables Terner Labs to do this work. Earlier symposia have covered the rental search process and planning for new housing, and the next one will be in June and will cover construction innovation. Each one has been across the country, and today's topic on homeownership is here in Detroit. This video here is pre-recorded in order to cover up for some audio issues that we had on site. Detroit is an intentional anchor for today's conversation. It has frequently been a case study in cyclical challenges and narratives that shape American cities. My family has lived in the region for 4 generations. I grew up as part of these sometimes competing yet intertwined narratives. Economic boom followed by deindustrialization, great migration and a center of Black culture, racist urban renewal and white flight, modern resurgence and steadfastness. The extremes experienced in Detroit also make it a breeding ground for inspirational new solutions that are led by people here, especially solutions that intend to increase wealth building and housing access for Black people in particular. There are also challenges here in Detroit today that are common across the Midwest and the Southeast, but that we do not give much attention to in national housing policy or technology innovation. These include the older homes in need of repair, the vacant urban land, the large share of people in the city with very low incomes, and the need for better mortgage products that serve the needs of people here. This brings us to our topic today, homeownership and wealth building. Huge topic. And innovation and technology have been instrumental in changing the landscape, from digital mortgage brokers to online credit counseling, credit scoring, and so much more. However, this innovation sits on top of an incredibly inequitable and unjust system. Systemic denial of homeownership to people of color, and especially Black Americans, has been among the most central contributions to the racial wealth gap in the US. Without thoughtful design and regulation, technology and innovation in the homeownership sector can accelerate and perpetuate this injustice instead of alleviating it. Part of the path forward involves continuing to anchor all of our work on the people it is intending to serve and support and what they need to thrive, and to rigorously hold ourselves accountable. With this in mind, we anchored ourselves for the event today by asking 2 questions. What are the most pressing topics related to innovation today? And what can we learn from Detroit and the Midwest? This led us to 2 subtopics that we'll walk through. The first is credit building and underwriting, and particularly the role AI may play in the future. This portion focuses mostly on the national landscape. Second, fractional ownership and solutions for older homes, particularly pathways that work for people to purchase homes who have low wealth or low incomes, and pathways that include a way to finance the rehabilitation of older housing. Current policy and regulations unintentionally limit the availability of fair market-based products to serve people who need smaller mortgages. And strict regulations, among other factors, limit the scalability of mission-driven fractional ownership models. This session is anchored more in the Midwest. Each portion of the event will have 2 sections that pull on distinct threads within these topics: an innovator showcase, highlighting the work from leading organizations that use technology or business model innovation. Then a panel discussion with leaders across research, policy advocates, and the housing industry to highlight the opportunities for innovation and research to move the conversation forward. With that, I'm excited to introduce the first section on credit and underwriting and our innovator showcase. We have 2 groups that will be presenting to you. First, we'll hear from Isusu, graduates of our first Housing Lab program. Their incredible success has contributed to the growth of the practice of including rental payment history in credit scoring. Our second speaker is the innovator, Jeff Walker, co-founder of Credivolve. Credivolve is a graduate of our most recent Housing Lab program in 2023, and he brings decades of experience to this work, including management roles at Fannie Mae and in the banking industry. Jeff will be followed by my colleague, Carolina Reed, who will moderate our first panel. She's an amazing leader in national research on homeownership, banking, and housing policy. Thank you so much, and we're glad to have you here today.
35% of Americans today are renters. There are 45 million people in this country that do not have a credit score. That's powerful, and that number continues to go up. We still have a crisis in this country whereby over 60% of people are living paycheck to paycheck. And it's not surprising why we have a huge racial wealth gap in our country today. The average white family has 10 times as much wealth than the average black family. What do we do at Isuzu? It's simple. 3 major things. We help renters report on-time rental payments into the credit rating agencies. Number 2, if you can't pay rent, 0 interest loans so you keep a roof over your head. Number 3, we substantiate ESG metrics, especially the S, and help capture that data so our clients can have more impactful reports.
Right, when we actually talked to the people we were working with, immigrants like ourselves who were struggling with financial inclusion, the takeaway was everyone knows they need to save. But there's something more fundamental, which is people's financial identity. If people don't have a financial identity, they can't navigate financial shock, they can't access credit. And I think that this is even more important because people kind of underestimate the impact of credit, but credit results in not only the ability to be a homeowner or get a mortgage or cheap debt, but also access to jobs, access to apartments, being able to get a higher education, and those are all the building blocks towards a better life in America.
Good morning. My name is Jeff Walker, and I'm with Equitable, and it's an absolute privilege to be here with you guys, especially following the folks from Isuzu. When I think about my background, just 3 short years ago, I was at Fannie Mae, when companies like Isuzu were the companies that we were trying to facilitate innovation from. And now you fast forward 3 years, and I'm here talking to you guys as one of those innovators.
I'm sure most of us understand that there is a cost to credit, but like me, you probably haven't put an actual number on it. Would it surprise you to know that Americans with low credit scores will pay nearly $500,000 in interest in their lifetimes? That's the average lifetime interest expense that a consumer with a FICO score below 620 pays for her mortgages, credit cards, car loans, and student loans, and it's a mind-blowing $400,000 more than a consumer with a 760 FICO score pays for credit. What would you do with an extra $400,000? Incredibly, this financial burden is the reality for 22% of Americans, more than half of those Black and brown Americans. Welcome to the high cost of low FICO living. FICO score is often a gating factor for credit, especially for those consumers seeking to refinance or finance a home. In the mortgage vertical alone, nearly 1.7 million potential homeowners annually are denied a loan for credit and debt-related issues. And that doesn't include the existing homeowners trying to lower their rate, consolidate debt, or improve their monthly cash flow. Today, no viable solution exists for lenders to offer underserved consumers a not yet versus a no. Unfortunately, these systemic impediments recall the definition of insanity. Same approach, same disappointing result year over year. For underserved consumers, the system is broken. It's time for a more practical approach to solving the lack of access to credit for the hardest to serve. I'm Jeff Walker, co-founder and CEO of Credivolve. Through our digital integration with lenders and credit counselors, Credivolve is a credit education and debt management platform that helps consumers who don't meet loan requirements become credit eligible and gain credit skills for life so they can typically qualify for a lender's products or programs in 5 months or less and gain credit wellness for life. And because the credit challenged consumer served in the CredEvolve model skews heavily toward low income, non-white, first-time home buyers, we have a very heavy concentration of exactly the type of consumer that lenders and investors want to help at a rate that far exceeds typical industry low to moderate income and minority penetration rates. Our platform bridges the challenges that have traditionally impeded targeted consumer credit and debt management education. We are the only cloud-based credit remediation platform that enables counselors to use the same digital validation and automated underwriting tools that lenders use. We help ensure that credit-challenged consumers can qualify for a lender's mortgage in as few as 3 months. Shortening the time to mortgage ready is critical because these underserved consumers are already out of time. Our platform not only helps consumers gain credit well-being more quickly, but we also help lenders reduce origination costs by serving customers already in their sales funnel. And with the support of counselors who now have a high-tech assistance to their high-touch approach, consumers who otherwise would be told no are now told, not yet, and here's how, at scale. What would you do with an extra $400,000? We also partner with industry leaders focused on addressing the needs of underserved consumers. We are a proud recipient of FICO's 2023 Decision Award for Financial Inclusion, and we were selected by the Mortgage Bankers Association, the Mortgage Industries Trade Association, to provide technical support to Convergence, their flagship effort to address the Black homeownership gap in hardest hit communities.
So I am absolutely thrilled to be here. I'm also a proud graduate of the last Terner cohort. And so couldn't think of a better thing to do than come to Detroit, hang out with you guys, and talk about ways to improve homeownership. With that, Carolina, I think I'll turn it over to you.
Thank you. I'm super excited to be here today. I'm Carolina Reed. I'm the Faculty Research Advisor at the Terner Center, and I'm going to be moderating our first panel, which is on fairness in credit and underwriting. So the historical record on fairness in underwriting isn't very good, right? We can think about redlining. We can think about outright mortgage discrimination. We can think about the fact that until the 1970s, women couldn't get a mortgage without a male cosigner. We can think about the subprime crisis and the ways in which lenders targeted underserved communities with risky products, leading to disparate foreclosures in Black and Brown communities across the United States.
This history has led to contemporary racial disparities in homeownership and wealth. And at the very foundation of these disparities is the process of underwriting.
And the ways in which society thinks about risk defines risk and prices risk. And I think we heard a lot of interesting ways to get around some of these sort of challenges with credit scores. Credit scores were an innovation, right? They were an equitable innovation when we first thought about them. They got us away from relationship lending and the bias that happens when you are face-to-face with a mortgage originator. It allowed us to extend credit to many more communities. But we're starting to really understand the ways in which credit scores, the way in which we measure price risk, really leads to material consequences and outcomes. And those consequences are really worse for communities of color. They are at the foundation of the Black-white homeownership gap, which is larger than it was when the Fair Housing Act was passed. It is foundational to the Black-white wealth gap. And so when we are thinking about how do we do equitable homeownership innovations, we have to tackle this question of how do we underwrite and how do we underwrite more fairly. And so I am very excited to invite my three panelists up, each of whom are thinking about underwriting risk, extending access to credit into underserved communities in new ways. Directly to my left, is a last minute addition from the second panel to the first panel. Unfortunately, Matria Spotzer from CRL was unable to join us at the last minute. And so we have Casey Matthews joining us on this panel. Thank you for joining us. Casey is a senior data analyst with Zest AI, where she worked on addressing algorithmic bias in mortgage lending. And she's going to talk to us a little bit more about what they're doing there. To her left, we have Sarah Edelman, who is the Deputy Assistant Secretary to the Office of Single Family Housing at HUD. I managed to get that out without tripping over all the words. Sarah has a long history working on expanding access to credit in underserved communities and was a dear and fun colleague during the foreclosure crisis, trying to figure out how we could mitigate the impacts of foreclosures on communities of color. So thank you for joining us. And then all the way to my left, I have Sid Mansour, who co-worked with Greenline, which advances technology to really extend access to credit in underserved communities. Really thinks about fairness and how do we measure, like, how do we measure fairness and we integrate that to our learning process. So please join me in welcoming the panel. I'm going to move over and try not to fall over and sit down. There we go. I'm going to start with you. We heard a little bit from Jeff and from others to the challenges that people who have poor credit scores, low credit scores, or no credit scores face. Can you talk a little bit about how our current mortgage lending system is broken and why the system doesn't work to reach people who should actually be able to access credit?
First and foremost, what a privilege to be here. Thank you for the opportunity. I'll start by this. A system was created a number of years ago, and the system that we're grappling with today is a raft of variables to predict risk. And risk has two parts to it. One is it has the risk of default and risk that a loan is going to be prepaid. And in determining these risks, the models have been built to take advantage of ratios that are antiquated, and they go back to ratios that may have had some myths back in the 1980s, but I not see that these ratios are in fact predictive of risk in a meaningful way, but they can be quite meaningful in creating discriminatory outcomes. And I'll just close by giving you an example of one of the variables that we have found in the work that we that does not meaningfully compute with the accuracy of this ratio. It does meaningfully weed out access credit, and that is a variable called the loan to value ratio. How much of value that you're using on versus how much of a loan you're getting against the property. We do not find in the work that we do that this variable has a meaningful impact on improving the probability of default or the probability of prepayment, but we do see it being used as a ratio against which lenders will make a decision on what to lend or not to lend. So this is where the technology innovations that we're here to talk about and make big impact is really uncovering these, making sure that the variables themselves are weeded out of the system. Let the variables lead individuals out of the system.
Great. Thank you so much. And I'm going to come back to sort of the technologies you use to determine risk in a second. But first, I want to turn it to you, Sarah. You work on FHA. FHA is a really important source of credit, particularly for first-time home buyers, underserved communities. How are you thinking about underwriting and increasing fairness in underwriting at FHA?
Great. Thanks. It's wonderful to be here, to sort of underscore what you were just saying. We are probably the go-to source for borrowers who are lower wealth. First-time home buyers, FHA serves twice as many Black borrowers by share than any other part of the market. 3 times my share and Latino borrowers. Any part of the market, 83% of our borrowers are first-time home buyers. Um, and you know, we have to be very strategic about where we innovate on the technology side. Uh, and part of that is because, you know, our first priority is making sure our systems are functioning well. We're later this year, we'll be coming out with a roadmap, a HA technology modernization roadmap, a plan to eventually phase out some of our older legacy systems. This work is not as exciting as the conversation we're having today, but it is so important. Can't build new without shoring up the foundation and the pipes of our program. Uh, in terms of a couple of places where we have focused on sort of some of the strategic bets we have made and are thinking about making, one, I just want to highlight sort of links to the Zoom video. We a year or so ago, year and 4 months, rolled out positive rental history. So the ability for a borrower to use 12 months of positive rental history as one of the, as part of their qualifications for a mortgage. This was something we expected to see some lift here, but it has exceeded my expectations in terms of truly broadening the pie for our credit. About 5,700 borrowers where they not have positive rental income history would not be able to be approved through our automated underwriting system. These borrowers tend to be slightly younger, lower wealth, Black and female. So it has been a very encouraging, it's been encouraging an encouraging experience. And so similarly, we, along with the GSEs, are looking at whether we could bring in, whether to bring in a more alternative credit data to our system. So that is an active work stream right now, and we're excited about that work.
Great, thank you. So this is about technology. People who know me know that I'm running away from AI, running and screaming. But you have embraced it and you are using it to fight for good. Can you talk a little bit about how you are using technology to increase fairness in underwriting?
Yes. So at AI, we use technology to broaden access to equitable lending. So mostly what we're doing is we are supporting financial institutions with AI models that are compliant and powerful to help them to decision their loans. So we also, along with supporting a lot of credit unions and financial institutions with developing underwriting models, have a lot of research that goes into fairness and trying to make models more fair, trying to include the data that's necessary without proliferating those existing biases in some existing like credit bureau data or alternative data sources. And so what we also have a focus in with that research is we're using tools like adversarial debiasing, big term. Basically, it's a technology that enables you to models more and to take that data that is adding in that alternative data like the require information. You're able to then use that data without rating or perpetuating existing bias. And so here it's really just taking your, like, let's say your model that you're trying to predict credit risk there. You're going to hit it up against a adversary model that's going to basically judge it to be more fair and to have more equitable outcomes. We also have other technology, like starting at the foundation with our race estimation tool called the Best Race Predictor that allows you to properly estimate people's race and ethnicity so that you can get that fair analysis correct from the get-go. So instead of using something that maybe works well for a homogeneous population, you're really able to get more into that granular level of actually seeing people and making sure that you're properly represented. And that way you're able to ensure that your analyses are correct and that you are able to build up that pipeline from where we typically work with like credit cards, auto loans, personal loans that like run with credit and build up so that people can get access to home ownership and get access to mortgage.
And that seems particularly important as you can't rely as much on sort of self-reported rates.
Yes.
So is that sort of kind of address that gap for lenders who are trying to do an assessment of their lending practices?
Yes. So for a mortgage, you're allowed to legally collect the race information, but you still probably maybe within like a third of the information missing. So you have to fill the gap with the race estimated to get a full or complete analysis on fairness. And then in like credit underwriting for credit cards, so loans, not allowed to have it information at all. So if you don't have a good picture at that level, like the foundation of building up your credit so that you have solid credit to get access to like a mortgage, you won't be seen. You won't have that access and get into the door to get to the home.
So you are doing something similar and thinking about how do we assess which of a borrower, but you're also thinking about how can we give lenders confidence to use these alternative models. Can you talk a little bit about your approach?
Yes, absolutely. So, piggybacking on what Casey just mentioned, we will also use techniques like adversarial debiasing, and there's a fervent a level of innovation that's happening in the space of how to make sure that we can develop models that can make less biased predictions on default risk, prepayment risk, and to put lenders more at ease around these alternative models that are more fair, discriminatory, because these models are not the conventional models that they have been accustomed to using. What we do is we stand by the predictions of these models and say to the lenders that if you experience a default, that default will be completely insured and we will cover, provided that this model was used to optimize and figure originate that loan. And I'll explain what I mean by optimize in a second. If a loan was originated that conforms to what these alternative models are recommending, then if that loan goes into default, we will fully insure that loan and cover the default losses and any interest income that was lost. Now, just to go back to the word optimization, optimization has many flavors to it. One way in which lenders have optimized loans to cover for their risk is by raising interest rates. So that's referred to as price optimization. The alternative is to also do just loan size or loan amount optimization. So instead of raising price to counter the risk of the loan, there's an opportunity here to use the predictive models to find a sweet spot where the loan size is optimum so that we can subdue some of that default risk. And so when a loan is originated and conforms to those optimization recommendations, it's now possible for us to insure those loans.
Great. And I was really struck by Jeff's data point on the interest that we pay as a differential interest by price and risk, about $88,000 for the average household. Because we also know that in the mortgage space, Black, Hispanic, low-income households are also less likely to refinance when it is optimal to refinance. And so that sort of initial cost of pricing risk really extends across the life of the ownership model, which really does then contribute to an exacerbating wealth gap. So let's bring these models are fascinating. Let's bring a dose of concern or considerations that we should be thinking about. What are the guardrails that we need to be thinking about as we're adopting these new models? And so we'd love to hear you all speak to how do you think about what should be the questions we should be asking ourselves as we are trying to implement these new models when our motivation really is to achieve fairness? Sarah, I don't know if you want to go first.
Yeah, sure. I mean, I think that in addition to access, first and foremost is along with access is the quality of the data and the predictiveness of performance. Borrowers need to be set up for success and housing market needs to be set up for success. So the quality is really important, of course. The other piece that may not be as intuitive is that the same intervention may be differently helpful and different of performance across about Jeff's slide for the folks who are at 760 versus 20. It's not intuitive, but when you start looking at some of these approaches, they have different outcomes depending on where on where the borrower is situated. And so that is another thing to keep in mind. And the other the thing on slide, where I don't think this travels at any risk of this, but I don't know that it's representative of the whole industry, which is bias. Are we locking in the same kind of bias that you actually, reduce through these technological interventions? And then finally, cost. What is what do these interventions cost to the borrower, or what gets absorbed by the borrower, and is it worth it? So those are some of the things that are front of mind for me. To make it more affordable to adopt these technologies. And we also really help to support them in understanding it. So, Shapley explainability. And so that's like a mathematically robust method for understanding how value should be attributed to. If you on the live stream know what that is, yeah.
Yeah.
I was they were not alone. What's your feeling? That's bad. One. Yeah. So just as simple as that, it's like if you're playing a basketball, and it's just showing how much each player contributes to that game. So we can do the same thing with the models that we're building. It's for like a mortgage model or just general credit card underwriting. We can do the same, saying how much the features are actually contributing, that we can help our customers and the lenders know how their models are actually functioning and the client that it has their Nile. And so instead of trying to rely on something like, okay, your that median value is this shift, which isn't really that robust, we're able to understand like by how much compared to like your population, this person is different and what is really driving their other thing that I would say, we really rely on our regulators to understand what is okay. And so us guidelines from our regulators is really crucial for us. We start using technology to make sure that it is fair and safe. If it's not always at all of the same levels, that we have that access to be able to implement this technology and know what it.
I want to just add to that, please. I think now we're living in the era of AI. It is the shiny new object, and there are concerns that those of us that are in this profession have about AI. One of these concerns is that as model builder, as AI scientists, pursue one broadly, and that is let's make the model as accurate as possible. And so the accuracy is single-minded goal that model developers have. And I think it is incumbent upon all of us in this profession to also introduce a second variable, a second metric by which we measure the quality of our models. And that is the fairness of the model. And accuracy can be quantified. We can actually measure how accurate is a model. Fairness itself also be quantified, and it is possible to measure the fairness of a model. And it is these two aspects of a model that should be pursued when models are built, and methods are absolutely merging some of the terminology that we see used. These terms have very deep meaning and a lot of value in the era of AI. What allows us to moderate AI and not just pursue AI models, single-minded goal of accuracy, just for accuracy's sake. When we do that, we will throw variables into the model that may very marginally increase accuracy if we're not also looking at what the implications of that are on the fairness side of the model. We won't realize that that one variable that got thrown in that improved accuracy very nominally could have created a significant increase in the bias of the model.
Yeah, really thinking about balancing that accuracy with access and making sure that you're not uh, taking people out who could afford and stay in a home. I think one other thing that's also really interesting that I'm hearing is the consumer facing part of this and giving consumers maybe more control over knowing what's going into a mortgage decision. Because I think in interviews that I've done with a lot of first-time home buyers, the denial decision and the FICO score itself or the credit score itself is such a black box that they don't understand, and that creates distrust without it running the entire system.
So on that point, AI can be a black box, and it's ironic because my career and my training is been in the field of AI for many years, but we tend to shy away from using AI models right at the point of decision making around loan approvals or loan pricing. We will use AI to help us determine what are some variables that could be brought into the decision-making process, perhaps. But AI as the decision-making engine in and of itself, something that we tend to shy away from because we want to be as clear, uh, clearly far away from anything that's black boxy as possible. No modeler should have to ever scratch their head when asked the question, how does this model work? They should be able to very explicitly articulate how it works.
Yeah. And I think that sometimes like AI can be a scary term. It can be something that we clump everything into like Gen AI and how like let's say like it's able to make all these decisions, it's able to like and we think that it's something that's it's magical things, but if the technology that we're using at Zest, we do use machine learning models. I feel like most work that they do, like logistic regression is a form of machine learning model. And we have dedicated a lot of research and a lot of time into researching how to explain and understand those models. So there's never a time that we're going to deliver something to the client we cannot explain. It's always explain it, and then we make sure that we have additional tools for our clients to be able to ask those questions and to be able to probe the model themselves. So yes, machine learning models, it can seem a little scary at first, but it's just a little bit of a tweak that you have to do and make sure that you're using robust methods to explain how these models are actually working and making sure that the end consumer can also understand through that.
In our last minute and a half or so, what are you optimistic about? What's the frontier for you? Or where do you think this potentially could go from each of the states that you're sending in?
From my perspective, you know, the things we're talking about here have a chance to be expanded by not, you know, a loan that gets to FHA or, you know, or the GSCs or VA, it's a loan that perhaps might not have been made that could now be made. We saw that with the positive rental history, which again, 5,700 loans here may sound modest. 5,700 loans and truly expanding the pie is actually quite significant. And so particularly for borrowers who are thin file and, you know, some of what we're talking about could really be a game changer.
We're very, very optimistic because right now we are seeing that ability because of additional data sources and the sheer power that computers now give us to explore different ways to extend data, uh, that we can indeed see very clearly that the envelope can be widened in a very responsible way for greater inclusivity around lending and home equity and home equity lending. And we see this with variable cash flow underwriting, capital data, safety, the inflows out someone's bank account, uh, with their permission, of course, really does open that aperture quite a bit. So there's a lot of optimism that we're looking at right now.
Yes, and I would just add that we're excited about broadening access to equitable lending and making sure that people are able to get access to that credit that really is life changing, and making sure that financial institutions understand how AI can be leveraged, pros, the cons, and helping people to get the understanding of the decision themselves or how to integrate it.
And I think what you're all three of you are talking about are real sort of system changes. And I'm excited about how those then get layered on to HUD Evolve in the SUSU, where you're really dealing with financial inclusion and laying the foundation for financial stability and working with counselors to serve as that sort of mediating dimension. First, please join me in thanking this incredible panel. And now it is my pleasure to welcome up the next panel of the day, which is going to focus on alternative homeownership models and really focus on how do we address this in places like Detroit. So please give us a minute if you're online as we adjust here, but thank you all so much.
Hello, hello, hello. Good morning or afternoon, depending on where you're tuning in from. My name is Cara Murray Bedell. I am the director of the Housing Venture Lab at Terner Labs, which means I get to work with and support ventures doing all kinds of amazing innovation in housing affordability. I am so excited to be here with you. We are changing gears a little bit. Our last panel, as you saw, was very focused on the underwriting process. We're going to talk about how we actually get people into homes and debate a little bit what home can mean. This panel is on alternative paths to home ownership and the possibilities and challenges of low-value homes. Directly after this panel, we will have a couple of innovators who are here with us in person, and we'll do quick talks just like the ones you saw ahead of the first panel, but they'll focus on alternative home ownership models as well. For this panel, though, let's start by talking a bit about low-value homes. I think for many of us who live on the coast or in bigger cities, the problem of low-value homes is not well understood. That there are homes that are already built that need some sort of renovation to be livable. So it's about finding the capital to make that transition. Or there are homes already on the market that are relatively inexpensive, like Tom from Ladder Up, who we'll hear from momentarily, works on homes in the $60,000 range, which as a Californian feels like a dream. But if you can't get capital to finance, or the people who want to buy those homes don't have cash available, then the low price tag doesn't mean anything. I'm really excited to talk about that because I think there may be a lesson there in getting more Black and brown people into first-time home ownership. The other conversation we're having is about alternative ways to get to home ownership. And I think it's important to discuss because there are solutions that provide lower cost options to become a homeowner, but these methods or models also mean that the home ownership may look different. It may look like living in a co-op. And do we feel okay about that, given that the primary wealth building vehicle in our country for nearly a century has been home ownership, from which Black and brown people were systemically and lawfully excluded? Is it acceptable to make low dollar or non-traditional homes a new cornerstone for Black and brown folks, for low-income folks, when there's a strong argument that they deserve the homes they were denied, that their ancestors were denied, that entrenched a huge amount of wealth disparity? And of course, we're talking about all of this through the lens of technology and the way that technology plays into all of this conversation.
with that, I will go ahead and introduce our panelists. Directly to my left, we have Alex Wall, who is the Senior Principal of Innovative Finance Solutions Network. Specifically supports the lasting affordability housing sector and developing financial and real estate strategies to grow their operations and housing portfolios. Next to her, Sonia Mays is the president and CEO of Develop Detroit, a real estate and housing development firm focused on improving housing stability and creating economic opportunities across Detroit. They've invested over $240 million in communities. And then at the end, we have Michael Neal, who's a senior fellow in the Housing Finance Policy Urban Institute. Mr. Neal's body of work has intersected racial equity, technology, and homeownership research exploring the implications of AI and machine learning for closing home ownership. Thank you all so much for joining us. I think as we begin, it makes sense to just kind of open with some context. Who are the people that are chronically left out of home ownership and why? And how can technology and innovation support? So maybe, sorry.
Happy to. So I think we know this story fairly well. So the folks who are historically left out of home ownership tend to younger, tend Black and brown, people of color, and uh, the reasons for this are pretty diverse and often complicated.
Yeah,
Exactly. We want to
let me jump in.
let's
No, I
talk
think
about that
that's- I think she's
complication.
exactly right. You think about the founding of this country, and property ownership was central to your ability to participate in this grand experiment. And in addition, there were also parameters around race and gender. And certainly, we have seen our country struggle progress through the 19th century, through the first half of the 20th century. Certainly saw federal policies passed trying to make progress and address those concerns around access that were discussed coherently in the last panel. And yet, even through that, we still see evidence that households of color, low-income households, but also, it's also worth keeping in mind, younger households, homeownership rates are lower for, with the expectation for younger households than older households, which suggests and indicates this kind of life cycle kind of perspective to housing, that you're moving from renter to homeowner over time, but for whom does that not work for? And I would also probably put in there some research that we've done in our center around LGBTQ people and families who are also struggling to achieve homeownership. So again, I think part of it, for me personally at least, is exactly what you said, that this is rooted in the very nature of what it means to be American. And even with the steps that we've taken, we still see evidence that certain communities are not able to move up through their life the way that we would like to see that happen.
I can speak to the second part of your question about increasing access to homeownership opportunities in tech and innovation. And I'm sure we're kind of all familiar that often the nonprofit sector is the last to access tech that market rate for-profit firms have been using for years. And so if we're focused on increasing access to underserved homeowners, home buyers, we also need to focus on increasing access to the community organizations and service providers that support those future home buyers. So I can provide an example that Grounded Solutions Network is working on. This year, we're launching Homes for the Future, which is a new initiative that takes the tried and true model of shared equity homeownership and combines it with the operational and back-end infrastructure of single-family rental operators, which up to this point has really only been used by larger corporate landlords, we'll say the Wall Street landlords, but kind of what this panel is about. It's not the tech that is the enemy. It's the way it's being used. And I probably don't need to spend too much time talking to this group about what's going on in our communities across the country. As Michael mentioned, the racial gap still exists. We heard on the video earlier, the average white family has 10 times the wealth of the average Black family. We know that in order to build wealth in the U.S., as most surefire way is through homeownership, and the amount of single-family homes in the U.S. is dwindling. Affordable single-family homes, those that do exist, are being swallowed up by corporate landlords and are being flipped into cash cow rentals. So I can tell you that there is a way to halt this cycle if we provide shared equity organizations the opportunity to purchase single-family rentals off the market and transition them into permanent, affordable homeownership opportunities. What oftentimes is limiting these shared equity organizations, and I can talk more about what shared equity means and the definition of that, but what often is limiting these shared equity organizations is the amount of public subsidy or subsidy in general available and the speed at which it's available. We need to compete with these massive firms that have ready cash on hand to purchase hundreds of properties in a neighborhood. So, as I mentioned, Grand Solutions Network is taking this tried and true shared equity model and leveraging this traditionally Wall Street tech to help shared equity organizations scale their housing portfolios.
One of the things that I like about a shared equity approach to home ownership is it really forces us as practitioners to think about the value of owning a home a little bit differently. So traditionally, we equate home ownership with wealth building, generational wealth building, and it does serve that purpose. But for a certain population, I do believe we have to start thinking differently about that. So my organization, we are real estate developers. We specialize in affordable housing. We do both multifamily and single family in the same organization. So, and we're based in Detroit, and so we serve predominantly Black and brown population. But the nature of our work means that we see people in life cycles. So we're developing rental properties and single family homes for home ownership opportunity, but as for property owners. So we those rental units through over a long period of time, and so we get to see what's really going on with folks as they are renters, but then what their potential is for going into home ownership. And one of the things that I continue to be struck by in this business is just how rent burden renters are in America. So over half of renters are rent burdened. And that number is meaningfully higher for Black renters. By contrast, somewhere around 21, 22% of homeowners are cost burdened. And so there is some correlation between being more economically stable with respect to your level of cost burdenness and home ownership. And so if you just focus on the house and owning a home as a generational wealth building tool, you kind of miss that for an important segment of our community. Owning a home for reasons that are complicated really does de-risk their financial profile on a month basis. And that for me is a really interesting point at which shared equity models really can kind of step in, and it becomes less about miracle wealth building and more about how do we unlock the potential, because we have lowered the baseline cost burdenness for traditional renter.
There's a good thread here where we have all these rent burden renters and we're asking, how do you get into home ownership from that place? And Michael, I want to bring you in here, but we didn't really define shared equity models. And I think I should say that in this case, we're talking about multiple owners of a single property that are sharing in the appreciation and equity building, which might also be capped to ensure that it stays affordable. Is that right?
Yeah.
All right, we'll go with that for now. And then, Michael, I would love to hear from you about how people actually get to home ownership and specifically the ways that technology can be helpful or hurtful with that.
Sure. No, excellent question. And let me say that that I think can in many instances be aggregated to community as well. To which we do have sustainable patient capital flowing into color can have can support a virtuous cycle in those communities, in terms of jobs and small business, in terms of reducing like all of those types of issues, all of those types of stuff are often consistent with a lack of care, a lack of people moving into the that does bring up this question of like, well, how can we encourage, knowing what some of these challenges, how can we encourage more, say, household income that have historically been excluded in ownership and technology? A lot of the important points were made in the panel around AI. But I will also add that I think that a couple things. First, there's some things that can be done on the supply side. Certainly, we've seen some encouraged news around the data as a way of helping builders identify projects that ultimately come to pencil out, particularly around affordable housing. I've seen CoreLogic, I've actually seen the Terner Center, kind of taking some steps in exactly this direction. Obviously, when we think about on the supply side, we are thinking a lot about the lack of labor. We're thinking a lot about the lack of particularly on the family side. That is something that technology can really kind of help. It is surprising that we do look at the share of panelized homes, share of manufactured homes, even though potential benefits, we don't see that kind of production. We don't see a strong increase in that kind of production. So that suggests there are other barriers, perhaps, but it also suggests there are opportunities actually learn, perhaps naturally. This is like YouTube, Europe, places like Australia, what have been doing this kind of work successfully, potentially be implemented here. And the last thing I'll say, turning back to the demand side, is certainly around with the entire mortgage originating process. A lot of us talked around underwriting. Obviously, there has been a lot of conversation around appraisals, and as we move from appraisal waivers of evaluation models, then what type of appraisal they use it to some degree. So it is important to make sure that that communities of color experience the same type of outcomes and accurate outcomes as others.
Fantastic. Sonia, I wonder if you maybe can jump in a little bit here too, because I know you also think specifically about the ways that this is affecting different populations, and you've used data a bit to do that, to figure out how this is affecting Black people specifically, and also Black people in the Midwest specifically. And given the context, I'd love to hear that.
If I had to describe my own personal feelings and beliefs about the intersection between affordable housing and technology,
Yes.
I'd say that I'm far more open to and enthusiastic about technology interventions on the production side than I am on the home buyer side. And on the productions, and that's for two reasons. So the first is because I just haven't figured out how we get out of this drastic affordability problem that we have both on the rental side and on the home ownership side if we don't produce more supply. Like, it's just, we are so far behind where we should be in terms of run rate for our society. We lost millions of units in the financial crisis 14 years ago. We lost more units of production over the pandemic. And so there's just this multi-million unit hole that we have to get out of. And I am increasingly bullish about factory built housing or any of the innovations on that side that'll help us chip away at that large deficit that we're facing. On the buyer side, in particular, in the communities in which I work, and I 90% of my work is in Detroit and I'm from here. I do worry about some of the complexity that gets introduced in what effectively has been a pretty stable 100-year home ownership model, right? Where you find a home, you get a mortgage, there's a whole system of lawyers and brokers and agents who kind of support that infrastructure. And yes, it is biased and it leaves people outside of it, but it's reasonably predictable. And with the introduction of tech onto the buyer side, I just worry about where bias will lurk and unintended consequences. And then at a very basic, direct human level, particularly in the Black community, there is a measure of distrust around quote unquote housing innovations. I mean, in this city in particular, Black homeowners and Black residents seemingly find themselves on the losing end of the stick of whatever is the thing, the home ownership thing or the mortgage product or the, whatever it is that's supposed to deliver. We historically, that hasn't always panned out. And so I do think, especially when you start talking about shared equity models, which by the way, I actually personally live in one. And so I know the value of them. But it's not a, it's just a sort of another thing that has to be explained and understood in a population that may be predisposed to be a little bit skeptical.
Yeah, I think Sarah's talked a bit about the fact that there is technology being used in all kinds of communities in lots of different ways. But Black and brown families have a real reason to feel concerned about people coming in and saying, look at this innovation, and because there's been lots of predatory housing things. And so if there is going to be innovation, how do we think about bringing that in a way that makes sense and feels real and honest, as opposed to what can often happen, which is look, we've come up with this technology at a very high level, but haven't thought about you, the consumer, you, the Black and brown person who are most in need of this thing that's happening. So,
and I'd say it's a super interesting space, right? Because if you think about technology at all, there are definitely some aspects in our society where technology has democratized things for Black and brown people and created much more access. And so, intuitively, housing could be one of those places, but it's just all about how tightly tailored it is and what the specific approach is.
Cool. We only have a little bit of time left. So I would love to just end with this question of thinking about how we get success in working with these folks who've been historically excluded, thinking about if there's any new mortgage practices or things that are coming up that you all are excited about. Specifically, we talked about housing supply. I would be remiss if I didn't say that I work for Terner Labs. We have a housing supply simulator that hopefully helps change levers to help people understand where to build. I work with housing innovators all the time, and I do hear this thing that you're talking about where even when they go in and do electrification, people are like, what are you doing to my home, right? Even though we're trying to restructure these homes that have been left out. And so if anyone has any thoughts about the success and the future of mortgages and getting more people into home ownership, given that there are benefits, even if it doesn't have the exact same wealth creation that it might have if they got a house in 1950 when it was impossible for Black people to get houses. But that's a different thing. Go ahead.
Sure. I'll take some time to explain a bit more about a shared equity model, just to familiarize folks with an alternative path to homeownership. So usually shared equity models are practiced by nonprofit housing organizations, community organizations. It's, for example, a nonprofit housing developer will acquire, rehab, construct a new home. As they're ready to sell that, they're also raising often public or private subsidy to then subsidize the cost of that home to a lower moderate income home buyer. The subsidy serves as somewhat of a down payment and lowers the rate of the monthly mortgage to make it more affordable. So familiar shared equity models might be community land trusts, limited equity housing cooperatives, deed restricted housing. So the unique thing about shared equity housing models is that when the home buyer goes to close on the home, the home close is also accompanied by a legal document, which might be a ground lease or a deed restriction that includes affordability requirements to make sure that the home goes to an affordable home buyer and thereafter. These are often 99-year legal documents that can be renewed upon resale. So we're talking about lasting affordability. These legal documents also include a resale formula that basically states when that home buyer goes to sell the home, they'll receive all of their equity, essentially whatever they've paid down on the mortgage thus far, plus a share of the appreciated value of the home. The remaining share that the home buyer does not leave with is then stewarded by the shared equity organization and passed on to the next home buyer. So that way that home buyer can benefit from the same subsidy down payment that was received by the initial home buyer. So there's a few benefits to this model in that it opens the doors to home ownership that many families and individuals wouldn't have had access to before, or even dream about home ownership. Also, the average shared equity homeowner, the median shared equity homeowner leaves with about $14,000 in earned equity through the homeownership tenure, as opposed to $2,000 that they contributed at initial purchase. And over 60% of shared equity home buyers go on to purchase a home in the traditional market. So this can be used as a stepping stone. Sometimes for many, it is an only option. And some real talk. This model is dependent on sharing the appreciation of a home across home buyers. So it's not a model for everyone. It's not the only model that should be in use, but it is definitely an alternative option.
Great. I think, Michael, maybe I'll give you the last word on this one if you have a quick comment right at time.
Sure. Yeah. No, I think I think two things. First, when I think about technology, particularly as it hits up against housing, is that home ownership in particular is very much an in-person activity, whether you're buying the home or you're building the home. And to my mind, that does suggest, number one, great opportunity. But also thinking about ways in which technology can, unintended consequences in terms of disrupting the industry. Who are the winners going to be? Who are the losers going to be? In terms of thinking about, where I think where I feel optimistic going forward, I think it is really this emphasis particularly from federal policy stakeholders, like Sarah, you were on the panel last time. I see Solomon in the audience. I see others in the audience who have really kind of made this focus and really partnered, I think, with local stakeholders in a way like Sonia's world, in a way that is meant to really drive the change that we need. I think housing also is one of those things that's local. And so those types of partnerships between the federal government who can bring things to scale and can standardize things with local stakeholders who really understand what's going in their market can only speak to positive outcomes in the future.
Amazing. Thank you. Do you
That's
have
a great
one?
point. That's a great point to end on.
Okay. All right. Thank you, Sonia. All right. We are going to transition out of this panel. The second part of this section is some innovators who are working in this space, and we didn't really get much into these lower, like the older home renovations and some of the things that contract for deed can happen. So I'm going to hand it over to Tom from Ladder Up, and we're going to learn about a couple innovations, and we're going to close with Solomon Green, the Principal Deputy Assistant Secretary. So I really implore everyone on the live stream to stay on to hear those final comments. But thank you all so much. I'm so glad. Okay, you'll go after Tom.
Hi, thanks for having me today. My name's Tom. I'm the CEO and founder of Ladder Up Housing. Our goal is to bridge the wealth gap by providing an alternative pathway to home ownership. We're based in Toledo, Ohio. Now, as you all know, and as we've discussed today, there's a lot of barriers that are preventing working class households from accessing home ownership. Credit score is the biggest barrier, which is something that the panel talked about earlier today. There's a lack of information surrounding the home buying process for our renter households. And then there's additional capital constraints that were also discussed. And all those things together lead to a lack of home ownership solutions for working class families. Unfortunately, a lot of the different alternative pathways to home ownership have been directed towards our higher cost markets and folks who are making more than 120% of the area median income. We define working class as people who are making between 60 and 100% of area median income. And so we developed a process that's dedicated towards Midwest communities and working class households. We purchase and renovate homes, rent them to tenants while they build their credit score, working with a nonprofit financial coaching partner with the goal of selling that same home to the tenant once they're able to attain traditional mortgage financing. I'm going to jump real quickly into each element of our process. So the typical home that we're buying is between $10,000 and $80,000 in value. It's a single family home, 3-bedroom, 1-bath, 1,200 square feet. And we're doing a complete renovation. So that way it's a home that a person not only wants to eventually buy, but is also one that's going to be able to get financed by traditional means. And so here's an example of a home that we did in Toledo. All of our homes, we do the same cosmetic rehab, which involves new paint, new flooring, new kitchen, and new bathroom. And then we have a systems line item because all of our older homes typically have an issue, whether it's plumbing, electric, roof. For example, for our properties, half of them, we've given them new roofs. And then when we're finished up that home, we're screening tenants based on alternative indicators of financial stability. So like was mentioned earlier, credit score doesn't tell the whole story. So we're looking at other factors such as on-time utility payments, rent payments, internet payments, car insurance, anything that's not captured in that credit score that can determine if somebody's financially stable and is going to be a good fit for what we're doing with ladder up housing. And then we have a rental agreement that's specifically tailored towards getting a person to home ownership. So we integrate rent reporting so that way people are getting credit for that rental payment towards their credit score. We're charging an affordable rent that represents a third or less of somebody's income, so that way they're not housing cost burden. And then we're partnering with that nonprofit financial coach to provide credit counseling, so that way that person can improve in their credit. And we think it'll take a person on average 3 years to get to the point where they have the credit score that they can purchase the home that they're living in. I put 640 up there because obviously the FHA is a great program, but unfortunately there are a lot of lending products out there that require 640 minimum with the community mortgage programs at the biggest banks. So that's why we really try to get our tenants up to a 640 credit score so they have a lot of options when it comes to the mortgage that they access. Now, I want to zoom out for a second and talk about some of the structural issues that we face when it comes to values of older homes. There's a big financing bottleneck that exists. Post-2008, a lot of the traditional lending sources for construction rehab financing dried up. And so private lenders are a major source of renovation capital. But unfortunately, they typically demand that the after renovated value of property is greater than $100,000, which chokes off capital to the communities that need it most. And then additionally, there's appraisal risk due to the lack of renovated comparables that exist in our communities. And so this attracts a different type of bad actor to our markets, whereas traditional private equity real estate, our largest corporate landlords exist typically in markets where there's more financeable homes. Instead, we find out-of-state landlords from Florida, California, and even out of country. We bought homes from people that are based in Central America and in Israel. And the example home economics kind of shows you what they're looking for in these homes, right? So they'll buy a home for $50,000 cash. They'll generate an $8,000 a year net operating income. They'll sell the home at a loss at the end of that period, but still generate a 14.5% internal rate of return. And so the incentive for that landlord is not necessarily to keep the asset at its value or keep it appreciating like most people would, right? They're okay with it depreciating over time. But what that does is it harms the communities that people actually live in, right? And all of these factors also lead to lack of accountability, to lack of owner concentration, different corporate shell games that folks play, and then the out-of-state nature, like I mentioned earlier. So a couple of quick potential solutions I'll leave you all with. One is using income-based appraisals, which I know somebody on an earlier panel mentioned, changing the way we view appraisals. If lenders use the same method of evaluating a property that these out-of-state investors did, the properties would be more lendable versus using a sales comparable approach. The second is allowing for increased leverage for local owners, so that way they can compete better with out-of-state cash buyers. And then lastly, and a shout out to Terner Center here, because this is something that you all wrote a paper on, I think about 5 years ago, about creating a different style of mortgage for landlords that have an option to purchase clause within their rental agreements. So providing them preferential financing terms to more incentivize folks to sell homes to the residents that are living in them that they're renting to. Thank you so much. And now I believe I'm going to be passing off to George.
Hi, everyone. My name is George Scott. I'm a principal with Black Star Stability, a private equity investment management firm based out of Washington, D.C. And we raised a fund focused on contract for deeds. And so, real brief, just to lay of the land, a contract for deed is a seller finance agreement whereby the seller takes back, financing, and then the buyer is on deck to all the responsibilities of home ownership, but none of the benefits. So they're doing all the repairs, they're paying the insurance, taxes, and they don't own the property until the last payment has been made. The product is not predatory. It's been used in more of a predatory manner of late. This dates back over 100 years ago. The inability to get financing in redlining districts, redlining communities. It came back during the GFC. This is over a $200 billion industry. What makes it predatory is it's a contract. So therefore, one missed payment, you can remove the resident from the space. Also, what tends to happen is that much higher rates, anywhere from 10 to 20% interest rates in some of the portfolios we've acquired already. What we do is take these products. We're not yield focused. We take them and convert them to traditional mortgages, fair and equitable, because it typically is the demographic that typically focuses on low and moderate income families and Black and brown communities. You'll notice that the chart on the right, small mortgages has a challenge in getting traditional financing because the fixed cost of doing a $500,000 mortgage is the same as doing a $50,000. So you'll notice that only less than 30% of homes valued at less than $70,000 gets traditional financing. And this map over here on my left, you'll notice that the $70,000 home or less value tends to be focused in the Midwest and the South. When we started the program as it relates to what we wanted to do to help families, and this is really home ownership, we were a lesson learned during the process as we bought portfolios and realizing these homes are not habitable because they need roof repairs. There was a resident didn't even have running water, furnace, all the basics of maintaining and making a home habitable. Some of the homes did not have. And so, our fund strategy, and again, it's an impact fund, was to acquire, CFDs and similar products, but we've now had to, at moments, make the home or do the repairs. In instances where the value of the home doesn't support the increase that would occur in the mortgage, we absorb those costs because our goal, no resident gets converted from a CFD to a mortgage and is underwater. That's just not the Black Star model. And these are just some of the items that have been, we've focused on and targeted in the repairs we've had to make. So you'll notice, 257,000, and of that, 40% was cost that Black Star had to absorb because we could not provide it to the resident where they wouldn't be stressed in making monthly payments. This particular case study, and I'm not going to go through it, but this is a gentleman. He's a former vet. He's an amputee. He had an organization that wanted to provide him a wheelchair ramp, but they were unwilling to do it under the CFD because they were like, you don't own the home, you don't have title. CFD holders don't get title until the final payment. So when we converted this to a mortgage, first of all, we did the repairs. We replaced the roof. We gave him a furnace. We gave him water. Then the organization came in and they provided the ramp. And this is one where we had to absorb the cost because the value of the home did not support us trying to, even though incrementally over 30 years, it's a small number, but the value of the home didn't support us making that gentleman responsible for that cost. Really quick on the technology front, there are 3 areas that we've been focused on. The finding this product is not so easy, it's fragmented. So what we are now is using technology. We have a chief technology officer. He's really identifying, classifying certain aspects for us to understand what's going on across the country to identify more product first. Secondly, from an operations perspective, our COO and our chief technology officer are working to become more predictive and prescriptive as relates to our universe of borrowers, because we could have someone that is a CFD holder that gets converted to a mortgage. So we own the home because, again, a CFD, lease to own, have similar traits to that. And so we have to be thoughtful about how we're managing that portfolio. And thirdly, we've become much more subject matter experts, I guess you could say, on CFDs. So we've been involving ourselves with policymakers and all relating to what's happening in this space. So we think we're coming up with, some insights on how you can really do small balance mortgages, eliminate this particular product and how it's being used, and give them some fodder for enforcement on those matters. And then this last slide, we did our first impact report this year, and it was well received in the marketplace. These are 2 articles on legislation that's currently out there on a federal and state level to address matters around CFDs. So with that, I think that concludes my presentation, and I'll turn it over to Samuel to close us out. Thank you, Solomon.
Great. Well, thanks, everyone. My name is Solomon Green, as Cara mentioned. I'm the Principal Deputy Assistant Secretary at HUD, leading our Office of Policy Development and Research. And I have the easiest job of the program, which is to thank our presenters and all of you in the room today and all of you joining us online, and to close us out. But what I realized watching the program is that I also have one of the 3 best jobs at HUD, and I'm joined by the other 2 who hold that distinction here. My job at HUD is to lead a team that supports everything we do at HUD, HUD's mission, with the best available research, evidence, and innovation. And I was joined today by DAS Sarah Edelman, whose job is to expand access to wealth building through affordable and sustainable homeownership. And also joined at the top of the program by RA Diane Shelley, whose job is to engage with communities and ensure that HUD's programs and policies respond to local and regional needs, including here in the Great Lakes region. So 3 fortunate and blessed HUD employees stand before you in this program. We all share a commitment to constantly learn and improve, which is why I'm so grateful to all of the panelists and innovators who shared their insights with us today. It was just such an incredible collection of wisdom and creativity. And I think they deserve a round of applause. For those of us in the room and for joining online, please thank them for their contributions. All 3 of us at HUD, as well as the entire HUD team, share a commitment to partnership, and we're so grateful to the partnership we have with the Terner Labs team. And I want to acknowledge Cara Marie Vidal and Michelle Boyd for helping to put this program together, and Professor Carolina Reed for her contributions to the program. Thank you so much. It's been a pure delight to work with Terner Labs over the course of the year on this series. We also want to thank our event planner, Adrienne Nutter, for her logistical support, and the Madison building staff for having us. Those of you joining us online should be very jealous because we're in a beautiful space here in downtown Detroit. Thanks to all of you who attended in person and joined us on the live stream. We'll share the live stream video when it is ready with everyone who registered for the program. And if you're interested in continuing the conversation on innovation in housing, I want to invite all of you here in the room and across the country to join us on June 7th through 9th in Washington, D.C., where HUD will host our 4th annual Innovative Housing Showcase on the National Mall. This is HUD's opportunity to showcase innovations in housing design and construction to help unlock housing supply, a topic we heard a lot about today, while increasing affordability, energy efficiency, sustainability, and resilience. We also host additional educational programming during the showcase to deepen these conversations and support the innovation ecosystem here in the United States. The HUD Terner Labs Housing and Technology Symposium series was announced at last year's showcase, and we are delighted to bring the series back to DC this June for the final installment. Please follow us at HUD User on your favorite social media app for updates on the showcase and all of HUD's work on innovation in housing. Thank you so much.